Every April, millions of Americans gather their paperwork, stare at a stack of confusing forms, and feel completely overwhelmed. For most people, the tax system feels like a black box designed to trip you up. Because the rules feel so opaque, rumors spread easily. You have probably heard someone say they turned down a raise or refused to work overtime because the extra money would bump them into a higher tax bracket and actually leave them with a smaller paycheck. Fortunately, the math does not work that way. The United States uses a progressive tax system. Under this system, you do not pay your highest tax rate on every single dollar you earn. We can look at this diagram to see how the math actually breaks down. Imagine your income as water, and the tax brackets as a series of progressively larger buckets. Let's say your salary is exactly $60,000 a year. As that water pours in, the first $11,925 fills up this first bucket. The government only taxes that specific amount of money at 10%. The water that overflows spills into the second bucket. This holds all the income you make between $11,926 and $48,475. That specific middle chunk of water is taxed at 12%. Finally, we reach your highest bracket. For your $60,000 salary, only the remaining spillover, about $11,500, lands in the 22% bucket. You are only paying 22% on that small puddle at the very top. That top bucket is your marginal rate, but your effective rate, the actual percentage of your total income that goes to the IRS, is a blend of all three buckets. Because of this progressive system, getting a raise always leaves you with more money in your pocket than you had before. To track all this water flowing in, your employer sends you a form every January called a W-2. This box shows your federal income tax withheld. This is simply the estimated advance payment your employer sent to the betterment throughout the year to cover the water filling your tax buckets. You will also notice boxes 3 through 6. These are for Social Security and Medicare. Unlike your income tax buckets, these are flat taxes charged at a fixed percentage across the board. The most important number for your tax return is up in box 1, which lists your taxable wages. If you check your own form, the number here is usually smaller than the actual salary you agreed to in your offer letter. That discrepancy is usually the result of pre-tax deductions. Things like contributions to a 401k retirement plan or a health savings account are tracked down in box 12. These act like a siphon. They legally remove water from your income stream before the IRS can pour it into the tax buckets. Once you sit down to file your tax return, you get another opportunity to shrink your taxable water volume. You get to choose between two filing options, standard or itemized deductions. About 91% of taxpayers choose the standard deduction. For a single filer in 2025, this is a flat $15,000. It is an automatic pass that tells the IRS to completely ignore the first $15,000 you earned. This is how a deduction works mechanically. It acts like a sponge, soaking up taxable income from the top down. If you remove $1,000 of water from your 22% bucket, you save the 22% tax you would have paid on it, which is exactly $220. Tax credits are different. Instead of shrinking the water in your buckets, a credit acts like a gift card applied directly to your final bill. A $1,000 tax credit wipes out exactly $1,000 of what you owe. The final amount you owe is determined by how well you manage this math. Lowering your taxes is about finding legal ways to use deductions and credits to minimize the amount of water the government is allowed to measure. The tax code is built to encourage specific behaviors. When you view the system as rules to guide your financial choices, you start to see straightforward opportunities to keep more of your money. The government intentionally rewards you for saving for the future. Rounding part of your paycheck into a traditional 401k shields money from your current tax buckets. Using a health savings account offers a way to save at every step. You don't pay taxes when you put the money in, as it grows, or when you spend it on medical needs. There is even a direct financial reward called the Saver's Credit. If you have a low to moderate income and contribute to a retirement account, the government will give you a credit, lowering your final tax bill dollar for dollar as a thank you for investing. Let's look at this chart again. Applying the $15,000 standard deduction to our $60,000 earner shrinks their taxable water volume to $45,000. The water level drops completely out of the 22% bucket, lowering their highest tax rate to 12%. A tax refund is the government handing back your change. Throughout the year, your employer sent money from your paycheck to the IRS based on the estimates in your W-2. If that total ends up being more than you actually owe, the government returns the difference to you. Filing taxes doesn't have to be a blind guessing game. Sort your income into buckets, siphon off the excess with deductions, and lower your bill with credits. The whole process becomes a predictable formula. To see how to put this into practice, join us in video 13, where we explain how health savings accounts work to keep your taxable income as low as the law allows.